Hi, I'm Deb Pervin, and this is another Tuesday Tweak. I hope you had a safe Memorial Day weekend and honored the veterans that give us our freedom. Today, we're going to talk about checking your accounting. I cannot tell you the number of clients that I have been working with whose data is incorrect. The accounting is not right. And obviously, if you have bad data, you're going to make bad decisions based on false information. So, here are a couple things I'm seeing. Your accountant or bookkeeper, are you sure that you set up your chart of accounts correctly? That's obviously a very important place to start. And then I'm just seeing some really weird things going on. I don't understand it, but there are a lot of mistakes. You, as the business owner, really have to review them carefully and every month. So here's some of the things that I'm seeing, just to give you a heads up. On your balance sheet, I've got a couple of clients actually, which is really weird, who obviously you book a sale, you send out an invoice, you got revenue on your income statement. On your balance sheet, you've got accounts receivable. Now, when that cash comes in, you add it to cash on your balance sheet and you remove the accounts receivable. Well, that's not happening, so they're double counting their assets. I have a distributor who is double counting inventory. Same thing as they are, but inventory. Not good. And then the equity section of your balance sheet. Make sure that your retained earnings are all the dollars that you've put in. Your net income is your current profit. And then also check those distributions. Your balance sheet is cumulative, so any money you've put in stays in there. If you're going to take money out, it goes in distribution and it's cumulative. So if you put 200 in and you take 300 out, you see both of those numbers. Do not net them. Taxes will have a huge problem trying to figure out what was going on. And finally, if you're lending money to your company or you're lending money to a subsidiary, the due to and due from has really, I've seen it all screwed up. It's negative on the asset side, it's positive on the liability side. Those need to be switched. So make sure that these are being accounted for properly. On the income statement, I'm seeing debt service. Now, your income, you get to expense interest, but you don't get to expense principal. You pay and you make a payment to an investor. You don't get to write that off as an expense. It comes off your balance sheet. It comes off of your liability side of your balance sheet, and your asset side is cash. Non-cash transactions, which are an important tax hedge, depreciation and amortization. Sometimes those aren't accounted for till the end of the year, but I've been working with year-end financials and they're not in there. That's a huge advantage to you to have some depreciation. That way you don't have to pay as much taxes on the income at the bottom. Finally, payroll. I have a client who's grown 20% a year, yet his payroll has shrunk 20% a year. That doesn't make any sense. There are a couple of different payroll accounts, and obviously the accountant isn't picking up them all. But who would know? You just have to look at these numbers and go, that doesn't seem right. So check your accounting. This is your responsibility as the business owner. And if you're not sure, if you're unclear, I am happy to help. That's it for our Tuesday Tweak. Let me know if you have any questions or suggestions or success stories, or you found something that looked weird. I'd love to hear from you. I'll see you next week. Thanks for listening.